Gold just crossed $5,000. And this could trigger a financial shock most people won't see coming. Let that satisfactorily sink in. Not a projection, not a forecast. Monday. Real market. $5,092.70. 17% gain this year. 64% explosion in 2025. Goldman Sachs now calling 5,400 by December. Independent analysts projecting 6,400. The London Bullion Market Association survey showing targets as high as 7,150. Now watch carefully. This isn't a rally. This is a stampede. Central banks, hedge funds, ETFs, retail investors, all moving the same direction, all at the same time, all with record-breaking speed. And here's the dangerous part. Why are the biggest, most sophisticated players on the planet, the ones who usually front-run everyone else, suddenly piling into a 5,000-year-old rock that produces nothing, pays nothing, and just sits in a vault? What do they see coming that you don't? This is where people get blindsided. By the end of this, you'll understand exactly why this outcome is now mathematically unavoidable. And what happens to everyone who ignores the signals. This isn't about gold bugs. This isn't about doomsday preppers hiding coins in their basement. This is about arithmetic. Pure, cold, unavoidable arithmetic. I've spent decades watching markets, watching capital flow, watching incentives dictate behavior. And I'll tell you something simple. When you see this many sophisticated players moving in the same direction, with this much capital at this speed, you don't ask whether they're right. You ask what they're seeing that you're not. Here's the answer. 3 numbers. 3 data points. Each one alone is significant. Together they create what I call a lollapalooza, a compounding of forces so powerful that the outcome stops being an opinion and becomes math. And this is where the pattern becomes impossible to ignore. Here's the first number. 60 metric tons. That's Goldman Sachs' forecast for average monthly central bank gold purchases this year. 60 tons every single month. Month after month after month. Now here's why that matters, and why it should concern you. Central banks don't buy gold because they like shiny objects. They buy gold because they're repositioning their reserves. And when a central bank repositions reserves, it's making a calculated statement about what it trusts and what it doesn't. Poland's central bank held 550 tons of gold at the end of 2025. Governor Adam Glapiński just announced they're targeting 700 tons. That's a 27% increase in gold reserves. Now watch carefully. Poland isn't some emerging market country outside the Western system. This is a NATO member, inside the European Union, a country that theoretically trusts the dollar-based financial order, and they're stockpiling gold like something bad is coming. Why? Analyst Ross Norman said it directly. Central banks are looking to de-dollarize, and where else could you go except into gold? This is the fracture point. This is where people get blindsided. Emerging market central banks, and now even developed market ones, are rotating out of dollar-denominated assets. Not because they hate America. Not because of ideology. Because incentives have changed. Think about this clearly. If you're a central bank holding U.S. treasuries, you're exposed to American interest rate policy, American inflation, American political decisions. You're trusting that whoever controls the Federal Reserve will act in your best interest. And right now, there are rising doubts about Fed independence. Markets are pricing in uncertainty. The referee might not be neutral anymore. So what do? You buy the one asset no one can print, no one can sanction, no one can devalue with a policy decision. You buy gold. That's not ideology. That's self-preservation. Incentives explain everything, and here's where the math turns into fate. When central banks buy 60 tons a month, sustained, structural, relentless demand. That creates a floor under prices, a floor that keeps rising. Keep this in mind. It matters later. Now the second number, and this one is even more telling. $89 billion. That's how much capital flooded into gold-backed ETFs in 2025. Record-breaking, in tonnage terms, 801 metric tons, the highest since 2020. Here's the dangerous part. ETFs are a proxy for institutional and retail conviction. When money flows into gold ETFs at this scale, it's not just individuals buying coins, it's pension funds, endowments, sovereign wealth funds, family offices. These are allocators managing billions, sometimes trillions, and they're making a cold, calculated decision to rotate into gold. Why now? Here's the trick. Chris Mancini, co-portfolio manager of the Gabelli Gold Fund, explained it simply. There's an opportunity cost to holding gold which has no yield. As interest rates decline, so does this opportunity cost. Notice what changed. For years, the argument against gold was straightforward. Why hold a rock that pays nothing when you can hold treasuries paying 4-5%? But now the Fed is cutting rates, expected to keep cutting. And as rates fall, the gap between holding gold and holding bonds shrinks. Suddenly, the dead money argument evaporates. And this is where it gets worse. Philip Newman at Metals Focus added another layer. Persistent concerns about overvalued equity markets are reinforcing portfolio diversification flows into gold. Think about what that means. Stocks are expensive. Bonds are losing their yield advantage. Cash is being inflated away. Where do you go? You go to the asset that's up 64% last year, up 17% this year. You chase momentum. Not because you love gold, but because you're running out of options. This is where people get blindsided. When $89 billion moves into a single asset class in 1 year, that flow creates its own gravity. Prices rise, headlines follow, more buyers pile in, prices rise again. This isn't sentiment, this is mechanics, this is Lollapalooza in real time. Now the third number, and this is where the pattern becomes undeniable. Bar and coin demand, physical gold, the metal you hold in your hand. Jewelry demand has weakened. Prices are too high for most consumers. But physical bar and coin buying, surging. India, Europe, key markets across the board. Now here's what makes this different. Frederick Panizzuti at Numismatica Genevensis explained the psychology perfectly. You don't need to analyze a balance sheet, assess credit risk, or worry about a country or sovereign risk. Your only risk with physical gold is the price direction. And here's the part most people miss. As geopolitics and geoeconomics have become more complicated, that simplicity has become more attractive. Do you understand what's happening here? When retail investors, the last link in the chain, start buying physical metal at $5,000 an ounce, it tells you something profound about market psychology. These aren't traders looking for a quick flip. These are people who want to own something real, something they can touch, something outside the financial system entirely. That behavior is driven by one thing: distrust. Not distrust in any specific leader, not distrust in any single policy, distrust in the complexity itself, distrust in a system that feels like it's held together with duct tape and promises. Think about this like a household budget. If you don't understand your bank, don't trust your broker, and aren't sure your government knows what it's doing, what do? You stuff cash under the mattress, except cash is being printed into oblivion. So you buy gold, the mattress money of the 21st century, and when this behavior goes mainstream, when regular people start thinking this way, that's not a signal. That's a confirmation. This isn't a coincidence. It's a system signal. Now let's connect the dots. Because this isn't random. This is a pattern. You have central banks buying 60 tons a month. Structural, sustained, relentless demand from the most powerful players on the board. You have institutions pouring 89 billion into ETFs. Allocators rotating in because every alternative has weakened. You have retail investors chasing physical metal. The final capitulation of the wait-and-see crowd. 3 different buyers. 3 different motivations. 1 direction. When incentives align like this, outcomes stop being opinions and become math. Now let's invert. What would have to happen for this to fail? The Fed would have to stop cutting rates. Equity markets would have to stabilize without a major correction. Geopolitical tensions would have to ease in Greenland, in tariff negotiations, in questions about Fed independence. All at the same time. Does that sound likely to you? I didn't think so. The math makes this outcome unavoidable. So where does this end? Goldman Sachs sees 5,400 by December. Ross Norman sees 6,400 as the high. The LBMA survey shows projections as high as 7,150 with an average of 47.42. These aren't wild guesses from newsletter writers. These are base cases from analysts who've tracked this market for decades. Yes, there will be pullbacks. Analysts acknowledge margin calls in equities could force liquidation. A sudden rollback in rate cut expectations could slow momentum. Any easing of Fed independence concerns could cool the rally temporarily. But here's the sentence that tells you everything you need to know. Philip Newman at Metals Focus said it directly. A meaningful and sustained decline in gold would require a return to a more stable economic and geopolitical backdrop, which currently appears unlikely. Read that again. For gold to fall significantly and stay down, the world would have to calm down, and nobody with a spreadsheet believes that's happening anytime soon. Now watch carefully. This isn't just about gold rising. This is about trust in the global financial system quietly breaking. Slowly, silently, but unmistakably, and the smart money already knows it. By the time most people realize what's happening, the move will already be over. So what do you do with this information? 3 things. Cold. Logical. No emotion. First, understand your exposure. If you hold 0 gold and 100% equities, you're making a concentrated bet that stability returns. That's not a plan. That's a gamble. Second, consider allocation, not speculation. This isn't about going all in on gold. It's about recognizing that when central banks, institutions, and retail are all moving the same direction, ignoring that flow is a form of denial. Third, watch the Fed. Rate decisions will dictate the opportunity cost of holding gold. If cuts continue through 2026 and 2027, the bull case strengthens. If cuts pause, expect a dip and probably a buying opportunity. None of this is advice. All of this is arithmetic. I've spent my whole career trying to understand incentives, and right now, the incentives are screaming. Central banks want out of dollar risk. Institutions want diversification. Retail wants simplicity. Gold gives all 3 exactly what they're looking for. This isn't about morality. It's about simple arithmetic. Subscribe if you want to think like smart money, not emotional money. I'll keep following the numbers so you don't have to guess.